18.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Startups lodge fresh appeals with the Finance Ministry to scrap or increase the 25 crore rupees threshold for exemption from angel tax. The industry argues only a small percentage of startups meet the limit, sent to clarify in the next few days as per reports.
Google appeals against the Delhi High Court's directive to Competition Commission of India to take up complaints made by the Alliance of Digital India Foundation against Google's new user choice billing system, which comes into effect tomorrow, the 26th of April.
Unacademy to hit group-level EBITDA profitability by the end of April, as per an internal memo sent to employees by co-founder and CEO Gaurav Munjal. The announcement comes after nearly 1,500 jobs have been cut at the EdTech unicorn over the last 1 year.
Hyperlocal content and classifieds platform Local raises 120 crores in Series B funding. New investors Global Brains and Sony Innovation Fund lead the round, with participation from India Quotient and other existing investors.
Winner of the Social Entrepreneur of the Year award in 2022, Haq Darshak raises fresh funds, gets 24 investors on the cap table. Backers include Namita Thapar, Lenskart's Piyush Bansal and both Aman Gupta, following the startup's pitch on Shark Tank in January.
InSpace City raises $1.5 million from Special Invest to set up in-orbit service centers for satellites in space. Antler India and Veda VC Co. lead the round, with participation from Aniket Capital, Point Pone Capital and others. The startup aims to build factories in this space.
Music streaming platform Spotify records its strongest first quarter earnings since going public in 2018, sees 500 million monthly active users for the first time ever. Strong revenue trend, with nearly half of the users being premium subscribers of the service.
And more Korean drama is coming our way on Netflix, as the video streaming giant plans to invest $2.5 billion in the South Korean market to fund future global hits from the Asian country, following the success of Squid Games and Physical 100.
Those were the headlines that we're tracking for you this evening. Now, EcoSoul Home, an eco-friendly home essentials product startup, backed $10 million in a Series A round. The round was led by Axel and saw participation from Think Capital Partners. The firm plans to use the funds for international expansion and launch new products. Joining me now to discuss this further is Rahul Singh, the co-founder of EcoSoul. Rahul, thank you so much for joining us on the show today. There has been a rise in consumer sentiment over the years for more sustainable everyday essentials. Talk to us about the products you have on offer. What are the kind of materials you use to make them?
Hey, Arundhati and Ritu, thank you so much for having me on the show first, right? So you're right. Yeah, we are seeing a very seismic shift in the consumer behavior with respect to sustainability. In fact, a recent Nielsen study found that 78% of the consumer actually want to go eco-friendly if they have a viable alternative to the existing plastic and paper products. And I think this trend is actually increasing by the day. So in order to cater to that trend, right, today EcoSoul across 6 lines of products sells more than 1,000 product SKUs, mostly in the US, North American, Canada, and the Western markets like UK, Europe. We have just launched a brand in India as well, and we have seen tremendous traction in India.
All right, you've also made your products much more affordable versus early eco-friendly players, and also at par with plastic and paper goods. So how do you keep costs competitive? Also, tell us about your best-selling products.
Sure. So essentially, this is why we actually started EcoSoul, right? Because we wanted to break the myth that going eco-friendly is expensive, right? So in order to keep the product cost, and really compete with single-use plastic, so we apply 3 formula, right? One is essentially having an on-the-ground operations team. So we don't work with any traders or middlemen. We work directly with farmers, directly with the manufacturers of the company. We have an AI-supported supply chain. So we're fully automated, me being the global head of supply chain for Wayfair before starting the company. And the third thing we do is essentially we bring innovative products to the market. So we work with we brought a lot of products to the market that are really from farm waste to actual products, like think rice husk, wheat starch, cornstarch, think bagasse, palm leaf. These are some of the products that were literally burnt in boilers before we started creating the products out of that. And we have seen tremendous growth once we introduced these products in the market.
All right. You've raised $10 million. So tell me, what do you plan to do with the funds? Obviously, geographical expansion and new products is on top of the agenda.
That is correct, right? So essentially, think of our $10 million as a war chest against plastic, right? So we are at a constant war with plastics day in, day out. So one thing that we'll be doing, we'll be bringing more innovative products to the market, fully compostable diapers. We'll be bringing products in the personal care, home care. We'll also be expanding in the North American market in the retail side. But Asian market becomes a very large focus for us after this fundraise. We are going to invest heavily in our expansion in India. And we'll also augment our supplier base and manufacturing base in India. In fact, we believe that by 2024, India can become our single largest hub for manufacturing eco-friendly products for our global markets.
All right. And what about revenues? Where do you hope to end this year? What's the online versus offline mix at this point?
So one of the great things about building a product or a company that is really eco-friendly is that our revenue is actually driven a lot by the customer demand. So over the last 1 year, we have seen 1,000% growth. So essentially, we have 10x our revenue. And not only that, what we are more proud about is essentially all the products line that have been in the market for us for more than a year, they are already becoming profitable. And we are inching closer and closer to the profitability as a whole for the company. So essentially, as we see from here on, we'll actually targeting a revenue of more than $50 million ARR by the end of this financial year.
All right. And US continues to be your biggest market. So what kind of revenues are you clocking from there? Talk to us about the Indian market and its potential at this point.
So US will continue to remain, and not just US, by the way, I'll basically put North America in one category, will continue to remain one of the largest markets for us. More than 65% of the revenue will still continue to come from the US as a market. However, when we launched our products in India in December 2022, right, India really surprised us, right? The traction that we are seeing in India and the consumer love that we are seeing in India is just phenomenal. So essentially, while US will continue to remain the large market for us, India will hopefully contribute between 10 and 15% of our overall revenue by the end of the financial year. In terms of online and offline mix, today we are almost 50-50. But as we scale, right, we really want to meet the customers where they are. And today, for home essentials category, 85% of the customers still shop at a store. So essentially, we will basically see by the end of this year, offline will contribute close to 60 to 65% of our revenue, with today's 50%.
All right. And give us a sense of the kind of insights you're getting from your consumer. Talk to us about how you view each of your markets and how do you customize based on consumer needs and preferences?
Yeah, so essentially, so the good part is essentially consumers are very clear what they want, right? They want plastic-free, tree-free, and they don't want products, right, that is actually going to live in a landfill about 1,000 years. So couple of things that we do is essentially we have on-the-ground marketing teams that actually look at all the consumer trends and what our consumers want. We customize those products according to each market when we launch the product. And essentially that helps us win in the global market, right?
Right.
So, for example, right, the products that we sell in India, right, are very customized to the Indian market. We have 4 compartment trays because we know that people actually eat, for example, pav bhaji or idli in that, right? So essentially, there are a lot of product level customization that happens for individual markets that we enter.
All right. Okay, Rahul, thank you so much for joining us on the show today. We're completely out of time and we wish you all the best going forward.
Thanks, Arun. Thank you so much for having me here.
All right, moving on. Adventum Student Living, which is the platform which owns the UniAco, UniCred and UniScholar brands, has raised an additional $5 million led by new and existing investors as a bridge to its proposed Series B round of $20 million. Now, ASL is a unified student lifecycle management platform which assists students in their application to accommodation journey with a digital-first approach. To date, they've helped about 5 lakh students through the platform. Joining me now to talk about the company's plans to scale and more is its founder and CEO, Amit Singh. Amit, welcome on Startup Street and thank you for your time here on CNBC-TV18. If you could start by telling us about this funding that you've announced, why the bridge equity and when do you hope Hi, Amit. And when do you hope to conclude this Series B round of $20 million?
So this is called bridge because this 5 million has come in before the rest of 15, but we are in advanced talk with other investors to come on board. These are larger investors. And timing wise also, this is not the time we need the whole of funding to come in. This is primarily the growth funding which we have closed, and this will largely make sure that the revenues we are on track to achieve what we have set for ourselves. But otherwise, yes, we are in advanced talks with other investors to the rest of the money to come in soon.
All right. So soon you're looking to close that, but you want to use these funds to expand your product offerings. What exactly do you mean by that? I mean, you have 3 brands. Will you expand into early career as well, or will you be looking to expand products within these 3 brands?
No, so the focus is going to be primarily to increase the product bouquet within the 3 brands. Just to give you a context, in Uniaco, from serving largely one destination country being UK, we now help students in finding accommodation in European countries, primarily your Germany, Spain, Italy. We have also expanded our operations into Australian market. So it's geographical expansion for Uniaco, adding more destination countries for uni scholars, which is into counseling business. So we started last year with one destination market being UK. Today we serve most of the destination markets. So largely the strategy or this money is going into expanding into the existing brands rather than expanding the horizon.
So, but will you be looking to expand into newer geographies outside the ones that you're already present in?
Yes, yes.
And what would those geographies be, Amit?
So, like in destination markets, as I said, we were helping students to find right opportunities and courses and their careers in UK. We have expanded into US, Australia, Canada, Germany, New Zealand, Ireland. These are the geographical expansions we have done in uni scholars. In Uniaco, as I said, we were doing UK, but now we also help students in finding accommodations in Germany, Spain, Canada, Australia. So that's how we have geographically expanded.
Overall, the company has had about 300% kind of growth since COVID, but it's also coming on a very low base. Is this kind of growth going to be sustainable? And, what about profitability across your 3 brands? What is the current burn and when do you hope to achieve that?
Yeah, so the company will be EBITDA positive by CY23, and we are pretty much on track on that. In terms of opportunity space, it's the way you look at opportunity. We are truly a global company with all 3 brands present internationally. So for us, if you see the target market is huge. Just to give you a context, Ritu, that globally there are 38 million students in these 6-7 destination markets I'm talking about. And each and every student needs an accommodation. A lot of them, they need counseling, and many of them, they need financing. So with this platform approach, the idea is to, when the student comes into our ecosystem, the idea is to sell them more than one product. And with that, if you add it up, it's a massive target market is what you're looking at. Just to give you a ballpark number, somebody has actually assessed this target market to be upward of $3 trillion. And when I say I'm talking about these 38 million students all put together. Yeah.
All right. That's a pretty large market, but how much of that do you have currently? And I also, out of curiosity, how many students actually stick with the platform for all of the 3 brands, seeking accommodation, seeking loans? How many use all of your products?
Yeah, so that's very interesting, Ritu. Like this platform we have built over time. We started our journey 3 years back with Uniaco. 2 years back, we launched our financing platform, which was UniCreds. And last year, we launched Uni Scholars. And since we have launched Uni Scholars, on an average, every second student in Uni Scholars actually is buying more than one product. And every third or fourth student is actually buying all 3 products and services from us. So it's very encouraging. The cross sales is doing wonders for us. And that's the whole point. What we saw in the market as a miss is it was highly fragmented market. The counselors were focusing on counseling for the student. Financiers were only looking at financing the courses. And accommodation was totally different subject matter. When we look at a student, we look at student end to end, we look at student as a single consumer, and we have created this product offering to the student so that student doesn't need to go out of ecosystem to buy any of the other services. In fact, just to extend this logic, we also help student in settling down once they have landed in the destination country. In fact, it starts a level before. We also help them in securing visas, opening their bank account when they are in their own source country. So just to give you a context, an Indian student today has a facility to open a bank account while they are in India before they embark on this study abroad journey. So these kind of eases are built around the offering. So even though the core offerings are around counseling, financing, and accommodation, there are a lot of built peripheral services which make the whole student mobility journey far more convenient and hassle-free.
Sure, Amit. That's quite interesting, and the ability to cross-sell and more opportunity there with your existing client base as well. Many thanks for your time here on Startup Street. It was a pleasure speaking with you.
Thank you. Thanks a lot.
All right, on that note, we're going to take a short break, but don't go anywhere, because up next, startup layoffs are on the rise and Simpl has cut its workforce by 25%. We find out what strategy the company is going to take going forward on the other side.
Welcome back. You're still with us on Startup Street. Now, the funding winter that has startups shivering is getting bleaker and could last a lot longer than earlier estimated. CNBC-TV18's Hormad Fatakia reports that with the chill settling in, India has not had a single new unicorn join the club in the last 6 months. Take a look.
Byju's, Simpl, Zomato, Unacademy. These are just 4 of dozens of Indian startups that have had to go in for large-scale layoffs to keep their lights burning. Access to easy money has dried up, and investors are pushing companies to put profitability over growth. A few companies have even had to shut down non-core verticals to cut costs, like Swiggy shutting down Super Daily in 5 cities, or Ola shutting down Ola Play, Ola Dash, and Ola Foods. The funding winter is not showing signs of easing up either. In the first quarter of 2023, investments into Indian startups is down 75% from a year ago. The freeze is visible across the board, from early stage funding to late stage funding, and even the funding rounds have shrunk in number. This has meant that India, which saw over 20 unicorns being created in the first 9 months of 2022, has not had a single unicorn join the ranks in the last 6 months. The turmoil in the startup ecosystem has also meant that many have had to put their grand plans for an IPO in cold storage. The list includes some marquee names like Boat, Go First, MobiKwik, VLCC, Oyo, and Mamaearth. Some have also had to resort to accepting lower or stagnant valuations in subsequent fundraising rounds. Even the startups that did manage a listing, often at eye-watering valuations, have been struggling, and as have many of their shareholders. Zomato, for instance, which kicked off the trend of new age IPOs in July 2021, has lost 50,000 crore rupees in market capitalization from the high it hit on listing day. Shares of other new age listings like Paytm, PB Fintech, Nykaa, and Delivery have also taken a beating on the bourses, a few correcting up to 60% from their IPO price. While some counters have recovered substantially from their all-time lows, they are still a long way away from their IPO price. But experts say that this kind of pain will not last forever.
I think you're going to see some down rounds. That's natural, and I think it's perfectly fine for companies to take their medicine and keep moving forward. So I'm optimistic that on the other side of this, sort of, whether it's 9 to 12 months is probably my personal guess. I think on the other side of this, you'll start seeing valuations become more normalized, and you'll also see the IPO market open when we have more stability around the interest rates as well.
They add that the funding freeze will also thaw, though there is doubt whether that earlier exuberance and the propensity to put profitability second to growth will return to what it used to be. So investors may have to wait a while for the next new age IPO that commands a staggering valuation. In Mumbai, Hormaz Fatakia.
Now, after laying off almost 25% of its workforce of 150 people, BNPL startup Simpl founder Nitya Sharma tells CNBC-TV18 it was a hard decision letting go of those 150 people because the company had overestimated growth prospects. In a chat with CNBC-TV18's Aishwarya Anand, he spoke about the reason for the layoffs, the path to profitability, plans to join ONDC, and a lot more. Here's a slice of that exclusive chat.
You've actually, Simpl has joined the growing list of startups that has laid off its employees, and from what we can understand, you've let go of close to 150 employees. I hope that number is correct. So I want to understand from you what was the reason behind it, and can we expect more layoffs this year going forward?
Yeah, we, as you said, unfortunately, I had to take a very hard decision to say goodbye to so many talented people who worked with us, helped us get to where we are now. One thing that we realized as we were planning for the next year was that what we expected will happen in e-commerce in the short term, which is the growth of e-commerce in the next year or two, was definitely an optimistic assessment we had when we were planning for growth the next couple of years. As we stood this year, we felt that we needed to operationally become a lot more efficient so that we are able to focus on the most important customer priorities. One of the things in e-commerce is there's just so much to do, so much room to cover. And, the macroeconomic environment last year was very different and sort of allowed us to think that we should probably hire a lot more people and work on many things parallelly. What we realized as we were thinking about this year was what we need to do is focus a lot more on the most important customer priorities. And so what we did was a difficult decision to reduce the headcount so that we can focus a little bit more and be slightly operationally efficient.
Okay, now talking on performance, take us through how does your FY23 numbers look like? Where does your revenue stand? And are you profitable yet?
No, we are not.
You're not?
Yeah.
Okay. Could you shed some light on some of the numbers?
Yeah, there are a few numbers that we talk about. We work with about 25,000 online retailers. We have about 5.5 million active users. Our revenues are, in mid double digits, $1 million per annum. We are not looking at profitability in the next couple of years, but our business is such that we have a lot of levers that if we want, in 2-3 years, we can be profitable. Right now, we are focusing on efficient growth. We're definitely focusing on investing in growing the customer base, merchant base, and investing in technology.
So the last you raised funds was $40 million that you raised in 2021. So how are you positioned when it comes to capital efficiency, and do you plan on raising more funds in the near future?
Yeah, our business is relatively capital efficient. We are, unlike a traditional payment company, we focus on merchants. Our customer is retailers, and what we describe ourselves as a merchant-first payment network. So that's what we do. What that enables us to do is run a very efficient business. So we do not have traditional burns that so many companies have around customer acquisition as much as traditionally that is thought of in payments. So it's a fairly efficient business. Currently, we're not planning to raise money. We are focusing on making sure that we are investing our resources very efficiently right now. We also believe this market is not a market to raise capital.
Now, could you also shed some light on some of the plans that you have in place for 2023, and are partnerships with bank also on the cards?
Yeah, so in 2023, as I said, we are making our platform more available to connect to other businesses and enablers out there. We have had multiple conversations with banks. We are talking to banks on, providing more type of solutions to customers on checkout. We are expecting to double at least the network of merchants. So as I said, we are close to 25,000 merchants right now. This should become north of 50,000 merchants by the end of this year.
What kind of impact?
And with that, it is a wrap on this edition of Startup Street from Ritu and me. Goodbye and many thanks for watching.